Most people overpay for life insurance, not because life insurance is expensive, but because the industry makes it confusing on purpose. And here's the part nobody wants to admit: to people with the same age, same health, same income, can end up paying completely different prices. One pays the lowest rate available, the other pays double, sometimes triple. Why? Because one of them knew the tricks, and the other walked straight into the traps that insurance agents, companies, and comparison websites use every single day. But today, you're going to be the person who knows the tricks. Because in this video, I'm going to show you exactly how to get the cheapest possible life insurance without getting upsold, misled, pressured, confused, or tricked into buying something you don't need. No fluff, no industry BS. Just the truth. No insurance agent will ever tell you up front. Let's begin. Welcome back to InsureBite, the channel that turns complicated insurance topics into simple, honest, real-world guidance, so you can protect your family without losing your money or your peace of mind. Today, we're digging into a topic that every family, every parent, and every breadwinner needs to hear: how to get the cheapest life insurance without getting tricked. Because let's be brutally honest for a moment. Life insurance should be simple. You pay a small amount. Your family gets a large amount if something happens to you. But the industry, oh no, they don't like simple. Instead, they bombard you with 12 different policy types, confusing writers, scary long contracts, agents who speak in circles, websites that look helpful but are basically sales traps, limited time quotes that change the moment you say yes, and the result: most people walk away feeling overwhelmed. And when you're overwhelmed, you either overpay, buy the wrong policy, or avoid life insurance, completely putting your family at risk. But here's the truth nobody talks about. Life insurance is only expensive when you don't know what you're doing. When you understand the system, the price drops fast, because the price you pay isn't random. It's determined by a few key factors that you can control, if you know how, and that's why this video exists. By the end of today's breakdown, you will know the exact policy type that gives the lowest price, the tricks agents use to upsell you, the biggest mistakes that raise your premium, how to get cheaper rates simply by timing your application, how to compare companies the right way, and the step-by-step blueprint to locking in the lowest possible cost. This isn't a sales video. I'm not here to push any policy. I'm here to give you the freedom to make smart decisions so you never get taken advantage of. Because protecting your family shouldn't come with hidden traps. So grab a pen, sit back, and let's break down the 7 parts that will save you money, stress, and years of regret. Absolutely. Here is your full 3,000-word script, including 7 deeply detailed parts, 350 words each. PLUS, a powerful closing with CTA. This is crafted to be emotionally engaging, educational, persuasive, and high retention for YouTube. When most people think about life insurance pricing, they imagine some mysterious formula hidden deep inside an insurance company's vault. But the truth is much simpler and far more predictable than you've been led to believe. Insurance pricing is based on risk, not randomness. And the industry uses only a handful of factors to calculate your rate. If you understand these factors, you'll understand exactly how to get the lowest price possible. The biggest one is age. Age is the silent tax on life insurance. Every year you wait, your premium rises, sometimes by 8% to 15% per year. That means waiting 2 or 3 years can cost you thousands more over the life of your policy. That's why companies love when people think about it, because waiting makes them richer. Next is health, which is where most people unknowingly get tricked. You don't need to be a bodybuilder to get cheap rates, but conditions like high blood pressure, recent weight gain, diabetes, smoking, sleep apnea, and even certain medications can instantly push you into a higher risk class. And once you're assigned to that class, your premium stays there for the entire term. Then there's lifestyle. Dangerous jobs, high-risk hobbies, DUI history, and nicotine use all make a huge difference. The difference between a preferred rating and a standard rating can double your price. But here's the part no agent tells you. Companies don't judge risk the same way. One company may penalize blood pressure harshly. Another may not care at all. One may hate nicotine. Another may be lenient with chewing tobacco or vaping. This is why 2 people with identical health can get completely different prices depending on the company. Once you understand what actually controls pricing and how companies interpret it differently, you gain the power to shop smarter, compare smarter, and lock in the lowest possible rate without falling into traps. If your number one goal is saving money, there's one policy type that beats everything else by a mile. It's not whole life, it's not universal life, it's not index cash value, variable products, or anything complicated. The cheapest, purest, cleanest form of life insurance is term life insurance. It's simple. You buy a term, 10, 20, 25, or 30 years. If you pass away during that term, your family gets the payout. If not, it expires. No savings, no investing, no cash value, just protection. So why don't agents push it? Because agents don't earn much from term life. Whole life and universal life policies can pay 10 to 20 times more commission than term life, sometimes even more. That's why so many consumers feel pressured, confused, or misled. The industry is financially incentivized to push expensive plans, even if you don't need them. But here's what the industry doesn't want you to know. 99% of families only need term life insurance. Not because whole life is bad, it has uses, like estate planning and tax strategy, but because whole life is expensive and unnecessary for most people. When you strip away upsells, commissions, and complexity, the unaffordable parts disappear, and you're left with a simple, affordable safety net. Agents won't volunteer that information. Websites won't highlight it, and corporate marketing campaigns aren't built around it. But if you want the lowest possible price, term life is the foundation. Everything else is optional. Most people overpay for life insurance because they guess their coverage amount. Some say, $1 million sounds good. Others pick whatever the agent suggests. Some go too low out of fear. Others go too high because of pressure. But there's a simple, proven way to calculate exactly how much coverage you need, based on math, not emotion. It's called the DIME formula, which stands for D debt, 1 income replacement, M mortgage, E education. Let's break it down. DEBT, add up all outstanding debts, excluding your mortgage, credit cards, car loans, personal loans. The goal is to prevent your family from inheriting these burdens. Income replacement. This is the most important piece. A simple rule: replace 10 years of income. If you make $60,000 a year, that's $600,000. This gives your family time to adjust, recover, and maintain stability. Mortgage. How much is left on your mortgage? Include it fully. Your family shouldn't lose their home because they lost you. Education. If you have kids, add $100,000 per child as a baseline estimate for education costs. Now add all 4 numbers. This gives you the most realistic, accurate coverage amount. But here's the part that helps you save money. You don't always need to fully fund every category. For example, if your spouse also works, you might reduce income replacement. If you have savings or investments, you can reduce debt or education. If you plan to downsize the home in the future, mortgage coverage may be lower. This is how you avoid overbuying. This is how you avoid overpaying. A smart coverage amount gives your family protection without drowning you in premiums. Insurance companies don't just look at your health, they look at your recent health behavior. And this is where many people accidentally sabotage themselves. For example, if you schedule your medical exam right after gaining weight during the holidays, your rates go up. If you take your exam when you're stressed, sick, or recovering from something minor, your numbers look worse. If you apply after starting a new medication, your rating can drop instantly. But here's the secret: you can time your application to get better numbers and a much cheaper premium. Here's how. 1. Apply when your health is stable, not fluctuating. Don't apply while recovering from illness, injury, or major stress. 2. Hydrate heavily 24 hours before your exam. This lowers blood pressure, improves cholesterol readings, and reduces false negative results. 5. Compare speed and process. No exam policies are convenient, but often more expensive. Fully underwritten policies are slower, but typically cheaper. 6. Compare reputation for payouts. A company's claims history matters. You don't want your family fighting with an insurer while grieving. When you compare companies using these criteria, you make decisions based on long-term value, not short-term marketing. This is how smart consumers shop. Now that you understand how life insurance pricing works, it's time to put everything into a simple, repeatable process. Here is your step-by-step blueprint. Step 1. Decide on term length. First, 20 to 30 years for families with kids. 10 to 20 years if close to retirement. Longer terms equals higher price, but long-term peace of mind. Step 2. Calculate your coverage. DIME formula. Don't guess. Don't copy others. Personalize it. Step 3. Apply early in the year. Younger equals cheaper. Every month matters. Step 4. Improve health before applying. Hydrate, sleep well, avoid caffeine, lose a few pounds, avoid alcohol before the exam. These changes can bump you into a cheaper risk class. Step 5. Compare 8 to 12 companies, not 1, not 2. A broad comparison guarantees the lowest price. Step 6. Avoid unnecessary riders. Say no to everything you don't understand or need. Step 7. Choose level term, not increasing term. Level term stays consistent. Increasing term tricks people with low interim prices. Step 8. Review every 2 to 3 years. As health improves or lifestyle changes, you may qualify for lower premiums. This blueprint is foolproof. Anyone can use it, and it ensures you never fall into the traps that cause people to overpay. Life insurance doesn't have to be confusing. It doesn't have to be overwhelming. And it definitely doesn't have to be expensive. The only reason people overpay is because nobody teaches them how to buy it the right way. But today, you've learned the secrets. You've learned the system. You've learned exactly how to avoid the traps and secure the best price possible. Your family deserves protection, but you deserve transparency. If you found this video helpful, subscribe to InsureByte. We simplify insurance like no one else. Like the video if you learned something new. Comment any questions. I reply personally to help you make smart decisions. See you in the next video. Stay informed, stay protected, and stay smart. 3. Avoid salty foods, alcohol, heavy exercise, and caffeine before the exam. All of these can artificially inflate blood pressure. 4. Apply before changing medications. New prescriptions equals new risk factors. 5. Lose a small amount of weight, even 5 to 10 pounds before applying. Insurance companies use BMI categories. A tiny weight change can move you into a cheaper class. 6. Quit nicotine for at least 12 months if possible. Chewing, vaping, cigars, everything counts. Non-smoker rates are often 50% to 70% cheaper. 7. Apply earlier in the year rather than later. Annual guidelines sometimes shift, and premiums rarely go down with time. This isn't about being perfect. This is about being strategic. When you prepare correctly, you give yourself the best possible chance of landing into a preferred or even preferred plus risk class, which can save you tens of thousands over your policy's lifetime. Let's get real. Most agents are good people, but the industry teaches sales tactics that aren't in your best interest. Here are the biggest tricks. 1. The whole life first trick. Agents often lead with whole life or universal life because commissions are massive. They'll say, "This builds cash. This is like a savings account. You'll regret buying term." But for most families, it's unnecessary and overpriced. 2. The lowball quote trap. Some agents give you an ultra-cheap quote up front, then later claim the underwriter updated the rating. Translation, they never intended to give you the low rate, it was bait. 3. Unnecessary riders. They'll add riders like accidental death, child coverage, waiver of premium, critical illness. Some are useful, most are not, and they inflate cost. 4. Policy layering confusion. Some agents suggest multiple policies for flexibility, but in reality, it creates confusion and higher commissions. 5. Urgency pressure. If you don't lock in this rate today, it'll go up. Or, this is your last chance to qualify. False urgency equals manipulation. 6. The financial needs analysis misuse. This tool is supposed to help you, but often it's used to justify a larger than needed policy. 7. Not comparing companies. This is the biggest sin. Most agents prefer a handful of companies because those companies pay them more, but not necessarily the best option for you. The best defense against these tricks is simple. Know what you need. Know what you don't. Know how to compare companies and policies independently. And that's exactly what we'll cover next. When shopping for life insurance, most people do the worst possible thing. They choose the company with the lowest initial quote. But that's only half the story. Sometimes a company looks cheap at first, but ends up being expensive after underwriting. Sometimes it looks cheap now, but skyrockets when you renew or convert. Sometimes it looks cheap because their process is slow, inconsistent, or outdated. So how do you compare companies correctly? 1. Start with financial strength ratings. Look for AM Best ratings of A or higher. Life insurance is only valuable if the company still exists 30 years from now. 2. Compare underwriting flexibility. Different companies treat the same health condition differently. Example, Company A penalizes high cholesterol heavily. Company B barely cares. Company C is strict on diabetes. Company D is lenient. This is why comparing quotes from multiple carriers is the only intelligent way to shop. 3. Compare conversion options. A good term policy lets you convert to permanent life later without medical exams. This can be priceless if health changes. Cheap policies often strip out these features. For compare renewal pricing, some companies have extremely high renewal rates after your term ends. Others are much more consumer